So to take a crux on the green flags or the must-haves. One is the what and how. The other bit is, of course, the maturity of the founder. How much do you rate as an investor the power of interpretation of the intangible? For example, the intangible of saying that it's not just the check that the investor is bringing in, but perhaps a lot more of value, be it in terms of doors to be able to be opened, be it in terms of further connections, be in terms of ability to draw much larger institutional investors on the cap table because of the pedigree. And therefore, because of those, the founder understanding the value of it and perhaps giving in those 5 to 10 basis points the valuation and saying, I'm not going to stick too much on the valuation because in the intangible, in the long run, I'll make much more than that. What's your take on that?
Not all founders think that way. There's very few founders who have the maturity to understand this, right? In our early stage world, I think founders just want the money at the start point, right? Whoever is giving the money at a better valuation, they'll go after it. It's only probably second time entrepreneurs who kind of understand this a little bit more as to what kind of investors you should have on the cap table, what you should not for your own business, and what kind of value add do you expect from the investors.
So do you see this? Sorry, go ahead.
There is a clear distinction according to me, the way early stage founders behave and understand this. But end of the day, I think the disproportionate importance to just raising the money is also there. I mean, the value that we as investors bring in probably range from 10% to 30%. But the larger part is always obviously the funds that is getting invested and the business that needs that funds.
So do you see a lot, and given that now Abler has started coming in a lot in the Series B stage, so do you see a lot of this mindset shifting in a little bit of more mature founders because they've raised maybe a couple of more rounds, they've raised and discussed with a couple of more institutional investors who are on their cap table.
Yeah.
And therefore the value of an intangible is being seen far more by these founders.
For me personally, I think when we speak to founders, few things which does stick out very clearly here. The first one for me is when the founders don't have their market known, like they don't know what they're operating in, who their competitors are, what are the different nuances, and they come and just stitch a story for you. And you know that they don't have depth in it. I think that's the first thing that kind of is a big no-no.
And how often do you see this happen?
Many a times founders come to us, and especially now that we understand microfinance, let's say, and we see founders coming and talking to us about the sector, having no clue who the players in the sector are, which is very bizarre because it's such a well-tracked sector now. But there are founders who do that, and especially if I look at a lot of fintech founders as well, right, who are trying to build new businesses, and then they pitch to us that this is the market and this is the size and this, and then when you start drilling that down and asking them for specifics, the
granular questions,
they have no clue what we're talking about, and that happens quite often. A piece of advice to all the founders who are reaching out to investors would be that you need to have your story airtight. Make sure you're well on top of your numbers, the market, the competition, the different players in the ecosystem, and how you as a founder are ready to navigate your business through the entire ecosystem. I think that's absolutely number one. That's where you kind of get tested, the depth of where you stand with your idea and with your business. The second aspect would also be, I would say, be very clear on why you're raising funds. Is it for growth? Is it for just working capital? Or is it just for getting your name out there that you want to raise funds while your business actually doesn't need it? And you have actually levers in your existing business which can generate enough money to sail you through.
So do you see this happening? Do you see this happening, Smriti, that a lot of times do you face founders who come in with the concept of raising funds because of glamour?
I wouldn't say just glamour, but I think there's just been a lot of hue and cry or publicity around raising funds, that your name need to be out there, that you're continuously raising funds, and therefore the name gets recognized in the VC world or the PE world. There is that thought which has got built around it. So
you're saying
sometimes
there are founders who believe that the credential or the hallmark of being successful as a founder is the number of times they actually raise funds. So it's a very interesting question. Why am I asking you this? There's a reason I'm asking you this. देख, एक founder के, मेरा thought ये है, एक founder के लिए ना, at least I believe as an entrepreneur, the most important commodity जो मेरे पास है, वो मेरा equity है, जो मैं पकड़ के रखना चाहता हूँ. I don't want to dilute it for the sake of dilution. I don't want to dilute it unnecessarily. So, is this something that you've actually seen? Because this is again something which goes back to our audience to learn from the fact that what I hear you to say is very logical, right?
Yeah.
Which is, if you don't need the money,
don't raise it. Absolutely. So, I have seen business plans where founders come to us, and this usually, of course, doesn't happen in the pre-series A, series A. This starts happening series B onwards, correct, right? Where the business has reached a certain level of scale. And actually, you can visibly see that if you have a controlled growth, right, you can actually turn it profitable and then, start accumulating money over it. But people just want to continuously raise funds. And in the process, I've also seen business plans where cash is just getting accumulated in the business, right? And that cash is lying in fixed deposits. And now I'm getting a little technical, but cash is getting deposited as term deposits for like 5-6%, while you're continuously raising money and diluting yourself for an equity return of 30% plus.
And that's the most expensive form of capital.
Absolutely, but people or founders don't understand that relation. They don't understand that, you have generating cash business, then why do you need to raise funds? And you need to really ask that question every time you're out in the market to raise funds. For me.
So your second takeaway, especially for our audiences, as a no-go, is if you're trying to raise money either out of pressure or out of FOMO, because a lot of times capital raising Absolutely. Is also about FOMO.
Yes.
Or about the fact that you just want to scale without understanding the power of profitability.
For me, yes, that comes first. For me, for me and for Abler Nordic as well, I would say, I think the business model which is, I might be actually now being few of the many investors out there, but investing into a business which is perpetually into loss making, I guess, makes no sense. Absolutely no sense.
What is the third largest?
Third one for me clearly would be if the founders wear multiple hats or have multiple businesses or interests. I think that's a complete no-go. If they are after a particular business trying to grow and scale and looking at investors to come and fund them, True. Absolutely your entire time, everything should be, and interest of course, should be aligned to that business. But I have seen a lot of founders who have done a reasonable job of scaling a particular business but also have multiple interests or running other ventures. For me, that's not...
So दो नाव पे रह के आप पैर वैसे भी नहीं
चला सकते. कभी ना कभी तो वो split होगा. And then you will be split half.
Yeah. Unless, and I want to put a twist to it again because of the advantage that we see so many things, unless those businesses are complementary to the main business.
That's a different thing. Then there's a business rationale.
Then your business rationale and you're consolidating, even though you may raise separate capital in that separate entity.
That doesn't matter.
As
long as the economic interest is aligned. That's True. What matters, right? Otherwise, completely diverse businesses. I've seen, it can also be that founders have raised a certain business into a certain level and then try something new. That's possible, but as long as you're finding a home for that, it's run autopilot, you don't have any further interest in it, why not? But at the same time, running multiple businesses, that's a bit of a red flag for us.
I think it's extremely important, and especially for our audience, these are very, very important learnings. And for people who are wanting to raise capital, and more important, not just necessarily just the niche sector of financial services that you deal with, but I think what you're saying is very broad-based in terms of investor outlook.
Yeah.
And I think it's sector agnostic. Irrespective of the sector, what you're talking about is great learning for founders or to be founders or people who want to go across and perhaps enter that journey of fundraising. I think these are very important learnings.